Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 16th of September. My name is Zhong, and I'm standing in for Daniel Lam, who is still competing in the Chess Olympiad in Hungary. Gold surged to a fresh intraday record high of $2,614.60 last Friday. Meanwhile, WTI oil broke below $70 per ounce, falling to as low as $66.28 per ounce in the past week. Some would attribute the divergence to the fact that gold is a defensive asset while oil is a cyclical asset. In our view, that only tells part of the story. On gold, there are a couple of other likely drivers for this continued strength. Firstly, lower bond yields and weaker US dollars as the markets anticipate for the start of the Fed rate cuts. Secondly, rising bullish tactical positioning. Thirdly, sustained ETF inflows, especially in North America. As for oil, demand outlooks has been intensified not just by soft macroeconomic data, but also a slew of pessimistic outlook shared by the major oil industry players at the Asia-Pacific Petroleum Conference in Singapore last week. IEA also added to the bearish outlook, warning that oil demand is slowing sharply as China economies cool. The agency expects a surplus to form in 2025 even if OPEC Plus doesn't taper its output cuts. Speaking of OPEC, it also trims its demand forecast for this year and next year. In addition, media reports suggest that Libya crude oil supply may soon return to the markets as domestic political rivals are near a truce. That said, we believe the room for further significant decline in WTI oil is limited due to several factors. First, the recent OPEC Plus decision to extend production cuts until December is likely to help mitigate excessive supply concerns. In addition, despite the optimism, there continues to be much uncertainty about when Libyan crude oil supply is likely to hit the market. Lastly, the potential supply disruption caused by Hurricane Francine in the Gulf of Mexico is likely to support prices. According to U.S. Bureau of Safety and Environmental Enforcement, about 670,000 barrels per day of production is affected, which makes up about 40% of the production in the region. Of course, there are also a few factors to monitor, including the domestic growth indicators in the US and China, the timing of OPEC Plus output cut taper, and the magnitude of the global inventory drawdowns. From a technical viewpoint, we see the closest support level for WTI oil at $63.6, the low last seen during May of 2023. Subsequent support sits at around $62.4, the low last seen in December 2021. Moving back to gold, while some of the technical and positioning data look stretched, the near-term macroeconomic risks accentuate the appeal of the yellow metal, given its hedging and diversification properties. The other fundamental drivers, including lower US interest rates, still weak US dollars, and strong central bank demands, remains intact. And that adds to the case to overweight gold in the portfolio. That's all the time I have for today. If you enjoyed this podcast, please help us to like, rate, and share it. Thanks for tuning in, and speak to you again tomorrow.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.